There was a time when the name Lehman Brothers symbolized over a century of American financial power. A bank so deeply woven into Wall Street's fabric that its failure was thought to be impossible. But in September 2008, that illusion shattered, and with it, the world's financial system trembled. This is the story of how one of the oldest investment banks in the world collapsed overnight, and how its fall exposed the fragile foundation of a global economy built on debt, risk, and trust. What really happened to Lehman Brothers? And why did its collapse mark the beginning of the worst economic crisis since 1929? Long before Wall Street became a symbol of global finance, three brothers from Bavaria, Henry, Emmanuel, and Mayer Lehman, arrived in America searching for opportunity. They started small, trading cotton in Montgomery, Alabama in 1850. What began as a humble family business would, over the next 150 years, evolve into one of the most powerful investment banks in the world, Lehman Brothers. By the early 1900s, Lehman Brothers had moved into the heart of Wall Street, financing railroads, retail giants, and industries that built modern America. Through the Great Depression, 2 world wars, and countless market cycles, Lehman survived, adapting, expanding, and growing stronger. Survival became part of their identity. The firm prided itself on its resilience, its ability to thrive where others failed. For over a century, Lehman Brothers wasn't just another bank. It was an institution that symbolized stability, ambition, and the American financial dream. But by the 1980s and 1990s, finance had changed. The age of digital trading, leveraged buyouts, and complex derivatives had arrived. Wall Street wasn't about steady growth anymore. It was about speed, ambition, and risk. Lehman Brothers embraced this new world completely. The firm expanded aggressively into investment banking, real estate, and eventually mortgage-backed securities. They became masters of turning debt into profit. Every loan, every mortgage, every transaction could be packaged, sold, and resold, turning risk into revenue. By the early 2000s, Lehman was riding high. Under CEO Richard Fuld, nicknamed the Gorilla of Wall Street for his intense, unyielding style, the company's profits hit record highs. In 2007 alone, Lehman reported over $4 billion in earnings, its best year in history. Behind the scenes, though, few realized how much of that success was built on one fragile foundation: the U.S. housing market. Across America, houses weren't just homes anymore, they were investments. And for Lehman Brothers, they were the fuel that powered everything. The firm believed that as long as people kept buying homes, their profits would never end. But as history would soon prove, the higher the climb, the harder the fall. By the early 2000s, Lehman Brothers had evolved into a global financial powerhouse. Its influence stretched across industries, from real estate and energy to the complex world of mortgage-backed securities. On paper, the idea looked brilliant. Lehman would bundle thousands of home loans together, sell them as bonds, and promise investors steady returns. It was marketed as safe, predictable, and endlessly profitable. The logic seemed simple enough. People rarely default on their mortgages, and home prices in America always go up. That single assumption would prove catastrophic. Fueled by competition and ambition, Lehman poured billions into housing. The firm didn't just invest, it bet everything on the belief that the housing market could never fail. To keep profits soaring, it borrowed heavily, sometimes over $30 for every $1 it actually owned, just to buy more of these securities. And the riskier the loans, the bigger the potential return. Soon, Lehman was deep in subprime mortgages, loans made to people who could barely afford them. Each one was a gamble disguised as stability. For a while, it worked. Every quarter brought record profits. Executives celebrated. CEO Richard Fuld was hailed as a Wall Street legend. But by 2006, the cracks began to show. Housing prices stopped climbing. Homeowners started defaulting. And the supposedly safe investments began to unravel. Inside Lehman's headquarters, anxiety spread. Analysts saw the numbers turning red. But leadership refused to admit it. They told investors everything was fine, that it was just a temporary setback. Behind the scenes, the situation was spiraling. Lehman held billions in assets that nobody wanted. And to keep up appearances, it used clever accounting tricks, shifting bad investments off the books to make the balance sheets look cleaner than they really were. By early 2007, warning lights were flashing across the entire financial world. Other banks began to pull back, sensing danger. Bear Stearns was collapsing. Merrill Lynch was wobbling. Yet Lehman kept doubling down, driven by pride, denial, and the desperate hope that the market would somehow bounce back. Didn't. When the housing bubble finally burst, the illusion shattered. Billions in value disappeared almost overnight. Lehman's stock plummeted. Investors panicked. And the company that once symbolized strength was now fighting for survival. The same ambition that built Lehman Brothers was now leading it to ruin. By 2008, the cracks in the system had become impossible to ignore. Lehman Brothers was sitting on billions of dollars in mortgage-backed securities, assets that had once seemed like gold, but were now turning to dust. Across America, homeowners were defaulting on their loans. Foreclosures rose sharply, and the housing bubble that had fueled years of easy profits was finally bursting. Inside Lehman's glass towers, panic began to spread. The firm's balance sheet was drowning in toxic debt, numbers that no longer made sense. Investors lost confidence. Creditors stopped lending. And in high finance, confidence is oxygen. Once it's gone, everything begins to suffocate. Lehman's leaders scrambled for a lifeline. They reached out to the U.S. Treasury, the Federal Reserve, and rival banks. Meetings stretched late into the night, searching for a buyer who could save them. There was a flicker of hope when British banking giant Barclays showed interest. For a moment, it seemed Lehman might survive. But over a tense weekend in September 2008, negotiations collapsed. No deal, no bailout, no second chance. On the morning of September 15, 2008, Lehman Brothers, a 158-year-old financial empire, filed for bankruptcy. It was the largest corporate collapse in U.S. history, involving more than $600 billion in assets. In a single day, tens of thousands of employees lost their jobs. Investors were wiped out, markets plunged, and what began as a banking failure became a global financial panic. The shockwaves rippled across continents, from New York to London, from Shanghai to Lagos. Banks froze credit lines, businesses couldn't pay their workers, and ordinary people watched their savings, homes, and futures vanish almost overnight. But beyond the numbers, the fall of Lehman Brothers symbolized something deeper, a collapse of trust. Trust in the system, in the experts, and in the idea that Wall Street knew what it was doing. The U.S. government rushed to save other institutions, AIG, Citigroup, Bank of America, but Lehman was left to die. Some said it was a necessary message. No one is too big to fail. Others believed it was a mistake that turned a crisis into a catastrophe. Either way, the world would never look at banks or risk the same way again. In the weeks that followed Lehman's collapse, chaos spread across the global financial system. Stock markets plunged. Banks stopped trusting one another. Credit froze, and the world teetered on the edge of total economic collapse. Governments rushed to act. The U.S. introduced a $700 billion bailout package to stabilize the markets. Central banks around the world cut interest rates to nearly zero. And for a time, it seemed like the world was holding its breath. But the damage was already done. Trillions of dollars in wealth had vanished. Millions lost their jobs and homes. Retirement accounts were wiped out. And confidence in the global economy, something invisible but vital, was shattered. For ordinary people, the crisis wasn't just about numbers. It was about dreams deferred, lives disrupted, and futures rewritten. It exposed how deeply the world had become connected, and how fragile that connection really was. Out of the wreckage, new rules and regulations emerged. Governments promised to never let this happen again. Banks faced tighter oversight under reforms like the Dodd-Frank Act. But memory in finance is short. Lehman Brothers became both a warning and a symbol, a reminder of what happens when ambition blinds judgment, and when profit overshadows prudence. Even today, the name Lehman carries weight. For some, it's a tragedy of arrogance. For others, it's the necessary collapse that forced a reckoning. But one truth remains: the world's financial system is still built on the same foundations of trust, risk, and belief. And like all great empires, it's only as strong as the confidence that sustains it. Lehman Brothers may have fallen, but the questions it left behind still echo through every trading floor, every policy meeting, and every market surge that follows. The fall of Lehman Brothers wasn't just the end of a bank. It was the end of an era, an age of unchecked optimism, blind faith in endless growth, and the illusion that the system could never fail. In the years since, the global economy has changed. Regulations have tightened, banks have merged, and technology has transformed how money moves. Yet, in many ways, the cycle feels familiar. Housing prices are climbing again. Debt levels, both public and private, are at record highs. And risk has simply found new places to hide, in cryptocurrencies, tech valuations, and shadow finance. Every generation believes it has learned from the last. But history has a way of repeating itself, just in new forms. When Lehman Brothers fell, it revealed something uncomfortable: that our economy isn't just built on numbers, but on confidence. The moment that confidence disappears, even the strongest institutions can crumble. More than 15 years later, the echoes of 2008 still shape our world. Interest rates rise and fall, markets surge and crash, and beneath it all, people still chase the same dream: security, progress, and prosperity. Maybe the real lesson of Lehman isn't about finance at all. Maybe it's about balance between ambition and caution, innovation and discipline, belief and reality. Because in the end, the story of Lehman Brothers is the story of us, our drive to build, to risk, to hope, and sometimes to fall. And perhaps the question isn't whether another crash will happen, but whether this time we'll be ready when it does. Thank you for watching. I'm Denzel, the voice behind Spring 1929. If you found this story insightful, consider subscribing. It helps the channel grow and lets us keep bringing you stories that shaped our world. Until next time, stay curious.